Hey, welcome back. Getting to episode 12 of the stocks you wanted to see. This time we have a couple that had some huge jumps following the Q2 reports. Don't forget to leave a like and check out the rest of the series, and let's get into it. To begin with MercadoLibre, they are a leading e-commerce platform in South America very similar to Amazon. If you are from the region, you most likely know them, they are at that level. I've been following them for I guess around half a decade, but never invested, or at least not yet. This has been a very successful growth story, and the stock is up like 80 times since going public in 2007. Now it's back to the all-time high from the pandemic level. We can see recently how the revenue even quadrupled since 2020, and that's a very impressive achievement. However, keep in mind that despite it quadrupling, the stock is up like a few percentages since 2020, and this is the point I'm making with high growth stocks. When the market expects a 20-30% compound annual growth rate, if they deliver that, then it's okay and the valuation should remain as it is, but if they don't, then you can see a 20-30% crash. Such a level of growth is already priced in, and you shouldn't see some huge spike when they actually deliver it. This is also why picking this kind of company at a very good valuation can quickly deliver some very good returns. Look at them in 2022 or Dell and Google a year ago. Sure, there are other factors that influence the price, but growth in this case is the number one priority. They can make around 5 billion in cash flows, placing them at a ratio of around 15 to 20. For a high growth tech stock, that's very attractive, and it's pretty much half of what Amazon or Google are traded at. But this is not a North American company, and that's the reason why you see such a ratio, but more on that in a bit. There is a big difference compared to the net income because of high working capital changes. Plus, usually, provisions also make a high amount of the difference. Still, not necessarily a bad thing, and the change in working capital can also show an improvement in the balance sheet. Financially, they are in good shape, with enough current assets to cover all the liabilities. They don't really have that much else, but it's a pure tech company, so we shouldn't expect otherwise. They maybe depend a bit too much on loans and credit receivables, which can be a bit of an issue if they need some liquidity fast. Still, not a terrible shape for this kind of company, so they are okay from this point of view. They need around 400 million per year in interest, which also shouldn't be an issue. So overall everything looks great, but we have to balance it with the market's valuation. Buying at any price can be very risky, especially with a company like this where the market's optimism is so important. Again, a 20-30% crash isn't uncommon with this type of investment. To this, add the fact that they are an emerging market company, meaning politics, exchange rates, inflation, leading to even more volatility. So this naturally has more volatility than Amazon, for example, so keep that in mind. Now, I know that they were called the next Amazon or the Amazon of South America back in the day when I first looked into them like half a decade ago, and I see articles like that even from a few days ago. The thing is, it took Amazon like 2 decades of constant innovation and market leadership in a very new field at the time, plus massive changes to get where it is today. Don't forget that this was initially an online marketplace for books. It barely had anything to do with the current company. Now, if they mean Amazon as in the e-commerce platform, yes, they are pretty much already there. So is AliExpress and a bunch more. But if they mean Amazon as in the $2 trillion corporation that's dominating like 50 industries, that's another story. You know, just the e-commerce platform alone isn't worth that much. When you add the cloud business, pharma, retail, music, movies, gaming, and especially the synergies between them, then you get to that 2 trillion valuation. The thing is, they have the advantage of being in South America and already having an example from Amazon. What it means is a lot of untapped potential since it's an emerging market, plus, as somewhat of a consequence, every company around them is much cheaper. You know, they are one of the few companies in the region that are at a relatively high valuation, and that, as bad as it may look if you want to buy them, is a huge advantage. They can tap an almost unlimited amount of US dollars from outside at zero interest and buy local companies for like 10x the cash flow in a strategic acquisition. Amazon has to pay like 20, 30, 40x or even more, and they didn't have such conditions. So if they are smart and play it right, and really all they have to do is copy and adapt what Amazon did, this can become one of the most valuable companies in the region or even on the planet. But that is if they want to do it and have a plan. The thing is, they aren't buying that much, and I think that's wasted potential. You know, if they issued like 2-3% per year and invested it, that's close to 2 or 3 billion, which can rapidly snowball into even better growth. Even if they get delivery companies or anything that would save money, that in itself can be very good for the margins. If they expand into other growth areas though, that can be even better and would probably continue to deliver good results. The issue is that if they don't do this, they might underdeliver, which can be terrible for the market. We saw tens of stocks crashing for similar reasons even in Q1 this year. Slightly missing the target or a bad outlook for half a year can easily lead to a 20-30% crash. And then they potentially miss the chance to become a true Amazon of South America, not just an e-commerce platform. So this is ultimately up to the management, but there is potential for sure. Of course, it won't be a $2 trillion company, but a couple $100 billion or even $500 billion if they do it perfectly is possible. But you have to be aware of the potential risk of that not happening and becoming just another e-commerce platform. If that happens, then it can easily crash significantly. Now, Coursera, this is an online learning platform offering various courses, diplomas and so on. The stock is down significantly since the IPO a few years ago, but as you are about to see, this might be one of those pandemic hype IPOs that's turning into a potential buy. Since this is a small growth company, they weren't really making that much money, but in Q1 this year they already made 18 million in cash flows. If they can keep it up and continue to grow, this can become a very attractive ratio. They already made another 17 million in Q2 when they had a 50% jump. They target a positive EBITDA this year, and it might be the breaking point that we see with most of the pandemic IPOs. You know, be unprofitable for some years while you grow the revenue, and then you eventually turn a profit which you then use to develop even more. The thing we see with a majority of those IPOs is that they started at very high valuations because of the hype, issued shares to take even more advantage of it, and eventually crashed like 60-80%. It's a huge and very good influx of capital for the company, but not so good for the people who bought 2-3 years ago. They aren't inherently bad companies and they can actually grow, but 15-25% growth per year wasn't enough for the market. You know, you had companies that barely made $1 billion in revenue valued at like 20-30 billion. Even Coursera was making less than 300 million in revenue, not profit, and had an IPO value of like 7 billion. That kind of valuation simply didn't make sense. You know, they offer courses for data analytics, Python, SQL, things that can lead to a very successful career. And now, with AI, there is even more to learn about in any field. The thing is, and this is my main issue, why use them? If you look at a random Google Data Analytics one, it's made and the certificate is offered by Google. If all you want is that certificate, you don't need to pay Coursera $60 a month, or maybe less if you have a discount, it's free. Sure, if you want an instructor, career support and so on, maybe, but is it worth $60 a month? I mean, if you are serious about learning and plan to maybe even get a diploma, yes, it's very cheap and you actually learn a lot of useful things compared to other options. You know, $400 a year is something you can probably recover in a month later on in your career. However, this is something that pretty much any competitor can do. But with the right marketing, I think there is enough room in this market and even a lot of potential. When you don't have that many differentiators, people will probably stick to the one that they currently use, meaning that if you manage to acquire people now, they can be pseudo-loyal. The good thing is that scaling this business only takes marketing and of course developing the platform with new courses and stuff, but not something that would cost a lot. The difference in cost if they had 100 users or 10,000 is meaningless. There is also potential from the business and government side, which currently isn't growing that much. Everything they offer should be more and more in demand in the future, so if they have a good strategy and know how to reach the right people, this can keep delivering growth. Financially, they are in a very good position with a lot of cash and zero debt. But a majority of what this company has is in cash, which might not be the best approach. I criticized Palantir for having so much money in marketable securities instead of investing, but even that is better than holding it in cash. They are currently missing on about 30 million per year in interest right now. But on the other hand, they have the liquidity needed to develop as well as the flexibility to get into debt. You know, for a 1 billion market cap, you get back like 610 million in cash and some other assets after paying the liabilities, plus 70 million in stock. So if you were to liquidate it, you wouldn't really lose that much, which is a good margin of safety. And this doesn't include the platform itself and its potential, which you can also sell, and this is very rare for a tech stock. They pay around 100 million per year in stock-based compensation, which of course isn't sustainable now, but they have the cash for it at the moment. Now, there is something different about them. Compared to the other pandemic IPOs who had very little competition, they went public when the market was already developed. So what they do now is already in a maturing market. 15% revenue growth in such a market is definitely impressive. Palantir, which still doesn't have a lot of competition for now, is growing at like 20%. So overall, this actually looks very interesting. There is potential and the margin of safety looks very good for a tech company. They don't have any long-term debt and there is a ton of cash that they can use together with issuing some notes to really accelerate the growth. Right now, even if you liquidate it, it's probably a profit, which is an extremely rare margin of safety for such a company. I'll definitely add this to my watchlist and we'll take a deeper look. I recorded most of this before the jump, but I adjusted a few things, and to be fair, even after the 50% increase, this is still pretty interesting. Getting to 3M, this is a diversified company making over 60,000 different products for healthcare, electronics, consumer uses and more. The stock is now half of what it was at its peak for a bunch of reasons that I'll say in a second, as well as the effect of the pandemic and high interest rates. This used to be a very attractive dividend stock back in the day, paying as much as 6%, but again, you'll see in a second, that's not the case anymore. Before a recent spin-off, they were making around 5-6 billion per year, but now they should make around 4, which isn't terrible for a roughly 55 billion market cap. That's a ratio of around 13.75, which is around average for them. Financially, they are in a pretty good position, with the current assets covering the current liabilities and not a lot of debt. However, they have other liabilities, which I'll show in a second, plus not a lot of non-current assets. They have a ton of treasury stock though, so in a way they have a lot of liquidity available. Overall, not a bad balance sheet. They had a spin-off recently that resulted in a new company called Solventum, which was a way to clean the balance sheet a bit at a cost of around 1.5 billion in cash flows. That one might be getting pretty interesting from a cash flow perspective by the way, but I haven't looked into them yet. That, combined with other issues, resulted in a 50% dividend cut, which was the main attraction about the company. Now they pay less than 3%, so around 1.5 billion. They target a payout of around 40% of the cash flow, which is generally not bad. With about 1 billion in interest and let's say $500 million in other liabilities and debt repayments plus refinancing, it should be sustainable. But less than 3% in this market is pretty bad. They have a new CEO since a few months ago and I see that very recently the CFO resigned and went to ADM instead. There could be potential for a turnaround if they decide to maybe clean the balance sheet or do some aggressive acquisitions or spin-offs and so on. Now, you probably remember the earplug lawsuit that they settled for 6 billion a year ago. However, they tried to do a Texas two-step where they move a certain amount of assets to a company that they split and blame for everything, which ultimately goes bankrupt. It was denied and criticized by the judge, by the way. What it does is limit the potential liability, meaning the money they give to the people whose life they ruined. Sure, it's tinnitus and hearing issues in this case, not cancer as it was the case for Johnson & Johnson, but it's still life-ruining, especially for a veteran who's probably already going through enough. Why I don't like companies that do this in general is because it's one of the scummiest things you can do. Yes, it's meant to protect the company and investors, but they put a clear price on the life of pregnant mothers, children, hearing and so on. Not to mention that it's trying to dodge the trial. You know, imagine that after a decade-long trial, the fine is 30 billion, but they say, sorry, we have 3, when the real company is worth 300. And look, I think I'm a capitalist, but this has to go. Hopefully this becomes illegal in the future and companies will be held accountable, which from the looks of it might be the case eventually. I know this opinion might be controversial, especially if you're an investor in one of those companies, but think for a second, what if, God forbid, it's you, your significant other or your child that's in the next lawsuit? And all of that is done for a 3% dividend for J&J, for example. you would see this from a very different angle. But there are other lawsuits to pay attention to. They settled the Forever Chemicals one recently, but they will keep coming. The thing is, when you make so many products, even if they are very good quality, and I can honestly say it is the case, eventually something will have issues, and that's a risk to remember. 99.9% of them will be very small and you won't even hear about them, but there is a chance to get those 6 billion, 10, maybe even more ones that can really hit the company. The thing is, what's interesting about them now? Sure, a 6% dividend was something, but now, for the risk and low potential they have, less than 3% is too little. Financials are okay, they make money, good products, but there is also the downside. For me, they aren't at some attractive valuation to justify buying, it's pretty much the average. But for a slow retirement portfolio or a pension fund, they could be okay. You know, they can be like a Pepsi or Coca-Cola, but in a very different industry, which is also very important for such a portfolio. Again, the spin-off company might also be interesting to check, especially if the original 3M shareholders keep selling. I didn't keep up with them for some reason, but about a year ago I remember that I was interested in buying for the dividend, which thankfully I didn't, but I don't remember why. Now, however, this is a different company, so I'm not really that interested anymore. Now, Patria Investments, this is an asset manager in South America with over 32 billion in assets under management. They target pretty much a 2x in the fee-related earnings, which is the main source of income, from 2022 to 2025. For that, they are doing a ton of acquisitions, including a very recent one. With the stock falling even without them issuing shares, this can quickly become a huge money-making company at a relatively small market cap. Then they can focus on dividends, buybacks and so on, which might attract the market. If they manage to reach such a target, that should result in, let's say, 200 to 250 million in distributable earnings, of which they seem to pay like 85% as a dividend. That would be around 170 to 212.5 million, meaning a yield of around 8.5 to 10.5%. The current assets almost cover the total liabilities, which is always a good thing to see. What's impressive about them is that they have no long-term debt. That can offer a lot of resilience and flexibility, and we can see that they took advantage of that with the recent acquisition. You know, they can use the money they got from the IPO and maybe even issue a bit of debt to really develop the company a lot. That way, they are very likely to reach the 2025 targets, which would put them in a very attractive position. One thing to remember is that since they give exposure to the Latin American economy, the political and economical environment can affect them. You know, elections, recessions, the US dollar gaining value against the local currencies can be potential risks. This can also be a good thing, and I've made a good amount of money out of that so far, but things can always change. Overall, it's an okay price for a good company, but of course, I'd prefer to get it cheaper. Making pretty good money, good dividend, zero debt, exposure to Latin America, so it could be an interesting position. So this can definitely fit some portfolios. They are very similar to T. Rowe Price, which I actually bought about a year ago for a similar dividend. You know, maybe below, let's say 10, 9, 8 to get a much better dividend, I would even add a bit. But again, keep in mind that there is potential political and economical risk which is inherent to the region. So again, good companies that really give perspective about the market. You know, looking into so many companies from different industries can give a good idea about how to value and what to expect from an investment. If you only looked into tech, for example, 99% of the companies in today's market would seem very cheap. Again, any suggestions or comments, please let me know and don't forget to leave a like. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.